Hello, hello. Happy summer. It's
Yes,
official.
one day after the summer solstice.
How are you?
It's very, very warm. I love it.
Yeah.
Ingrid doesn't like the heat, but I love it.
Me too.
I
Feels
really
so
do.
great.
I really do. So we have kind of an anniversary, coming up this week.
Yeah,
or
tomorrow, I think.
Tomorrow.
Yeah.
You've been with us for DMG for 14 years.
14
That's
years.
half of a career already.
Well, or a quarter if you're looking at my career. I got little kids. I'm working forever.
It's funny. The average investment advisor is like 65 years old, and they think they're still in the middle of their careers.
Yeah.
Right?
Well, I know one.
They never want to retire. Ever.
Yeah, no.
But I got to say, it was one of my best decisions to hire you.
Aww.
And bring you on and promote you to be a partner of the firm. You are just. It's funny. I was trying to figure out how to say this the right way. No, it's like I was going to say, you haven't really matured that much since you got here at 26. But what I meant was you came with super mature. You were 26 years old, and Ingrid and I were like, I guess we have to hire her because she's so amazing. And you just were, there are people that come with batteries included, right? And you were just absolutely one of them.
Thank you.
So,
we added some life wisdom in the last 14 years.
Yeah.
Lots of things.
But. Yeah. We've all of us have, right?
Oh boy.
But it has been a great ride. And thank you for being here.
Oh, thank you.
You made a big difference.
Thank you.
It wouldn't be the same company without you.
Thanks.
By any stretch.
It's been awesome 14 years, better than I could have ever imagined. And I said to him this morning, I never imagined I would be at a job for 14 years. Like,
yet, here you are.
I bounced a couple times.
But it kind of goes by fast, right?
Oh,
and
yeah.
You look up and you're like, oh my gosh, 14 years.
Oh, yeah. Well, I see some of our first headshots and I'm like, who is that child in those headshots? How did
Or me. I'm like, look at who's that young, handsome guy there.
Yeah, your hair used to be red.
I know. It was great. Yeah. I had a little more of it too, I think.
As they say, my coworker got me this mug. I don't know if you can see it. It says, it's a cruel world, like accrued interest.
Love it.
It's pretty funny.
Who got you that?
Liam, our coworker here. Yeah. Thank you, Liam.
Thanks, Liam.
I love mugs. Send them over.
Yep. Yep. So
let's do this.
Welcome to A Place of Possibility. I'm Richard Del Monte.
And I'm Angela Wright.
And we are happy to have you here with us on this beautiful, warm day. Yes. What are we talking about today, boss?
Okay, so today we are talking about the real estate market. Again, actually, we discussed selling your home last week and we got a lot of questions. It seems as though the real estate market has sort of turned on a dime. It's not quite a seller's market anymore, potentially. And we've got interest rates soaring. Where you were able to get a sub 3% mortgage back in January, you're now looking at 6.7% today.
What? Is this 1980 again?
Or 2006. I bought my first house in 2006 and my interest rate was above 7%. It's not that ancient that we were in this place.
And when you did that, did you feel like it was just like normal?
Yeah.
It didn't seem outrageously high?
No.
Interesting.
That is some, it was average for that time.
Wow. Isn't that interesting that we've really gotten spoiled by the 3%?
Yeah, they call it recency bias in behavioral finance. Look it up. It's interesting.
Yeah. But all through my life, other than recently, a 7% mortgage rate was about normal.
Yeah.
For sure. Yeah.
And so, you had all these people with all these cash making a run on homes, everybody moving everywhere in COVID. You really had this seller's market where, the minute your house went coming soon, you had 72 offers, all of them, hundreds of thousands above asking price. And you really didn't have to do anything to get that. And it's noticeably cooling. So today we're going to talk about from the seller's perspective, from the buyer's perspective, and especially from the borrowing perspective, what you should be considering and looking at.
Yep. So we're talking about housing prices. It's no surprise really that the market would be cooling a little bit because the Fed has taken the punch bowl, away from the party, right? I mean, if given how much mortgage rates have risen, if all the regular people, in other words, people that I consider the regular that can't afford to buy a house for cash, they're kind of out of the market by and large, and so that's a lot of demand coming out of the situation, the equation, and so they're kind of looking at the fact where the property rates have gone up 50% in the last year or two. And also now interest rates have doubled, more than doubled. So they're kind of like, oh my gosh, we're out. But there are a little subset of people we've been reading about anecdotally and seeing it that are like, this is my last chance.
Yeah.
We're going to throw everything we've got into getting this mortgage. We're 6.7, maybe they're going to go to 8 or 9 or whatever. And the prices are going to go up even more. So we're going to do what we can to grab this house at this point.
Yep. A little panic buying.
Yeah. Panic buying on top of what we've seen is panic buying already. Right.
Right.
And so we think that probably, might not have to do that. We're going to hopefully give you some other thoughts that might, go against that thinking.
Yeah. So, okay, housing market first. Mortgage applications are way down, 75% from a year ago. This is the lowest in 22 years we've seen for new mortgage applications. So even though there are tons of people still willing to pay in all cash, significant number of folks can't do that, as Richard said. And so overall, homes that sold in a week previously are now taking 2 weeks to sell.
Oh, you're kidding. That's horrible.
Weeks.
Oh my gosh.
Can you imagine? I mean, I think
the horror
when I
all.
bought my home in 2006, there was like one offer in 60 days. And it's now, like my neighbor's house just sold for $200,000 over asking, all cash in, 2 days. So, so that's according to the SF Chronicle yesterday. And by January, it's expected that the market will have cooled down significantly. And then, that gives buyers time to actually think about what they're buying and whether or not they want a particular property without like the bidding war that's got everybody in a frenzy and in over their heads.
Yeah. So in other words, you got a chance to take a breath. And we're not talking about, when we talk about cooling, we're definitely not talking about a crash like we saw in 2006 and 2007, right?
Right.
It's not that. I mean, but most people think, oh my gosh, it's going to be bad. We're just talking about letting a little air out of the market.
Yeah. And you have to remember, like at the, OA, it wasn't just about interest rates. It was, remember, lenders were lending to people who could not afford their mortgages. And they had created all of these really creative mortgage products to get people into their houses. I was the beneficiary of one of those. Yep. And, it was like, put 2% down and then you get this big balloon in 5 years, and nobody understood it. And so you had all of these foreclosures and all of this excess supply, which is a big part of what led to the crash in the housing market. That is not happening right now.
Right. So we're just talking about getting to equilibrium where the number of buyers and the number of sellers are roughly equal. So it's going to you won't have to be worried about making multiple bids and, beating the next guy by $20,000 or $50,000 to be able to get this house.
Writing desperate letters. We're a family.
Oh, we're a family. Let me tell you the sob story. Bring a writer in here. We're going to write this thing so it pulls their hearstrings. And you don't have to make compromises that you don't want to make, like, oh, that avocado furniture from, or the avocado appliances in the kitchen from the 1970s. Well, maybe that'll come back into style. We could probably live with that because we're certainly not going to have money to be able to repair that or remodel. Right. Because we spent everything we've got. So those kind of things you probably won't have to do, hopefully, when the market is more balanced. Yeah.
And speaking to, from the seller's perspective, you're sitting here going, oh my gosh, have I missed my chance? What am I going to do? Again, no, because the market isn't crashing. Instead, it's equalizing. And so basically that means that, the second you put your house on the market, as I said, you won't receive 5 offers, 200 above asking. Instead, you might receive a couple of offers, you might get some negotiations, and you might have to be a little bit patient. You might have to stage your home again or fix up the yard. Whereas, you just slap a sign on it before the thing is sold in 5 seconds. So sort of back to what I would consider normal home selling processes and procedures.
And buying. Yeah. So let's talk mortgages. Shall we?
It's what's on everyone's mind. Yeah.
First, if you're a buyer or you want to be a buyer, you might, of course, be inclined to be sort of panicky right now because these rates have gone way, way up. By the way, I will toot our horn. I was use a little toot thing.
Toot. Watch out, everybody.
We did say back on our early podcast earlier this year that if you wanted to refinance or buy a house, you should buy it then because rates were going to go up. We actually were right.
Every once in a blue moon, we're right about something.
Even a stop clock is right twice a day. So you got the average 30-year fixed mortgage rate at 6.7% today, and that's kind of like a wow. You got to just sit there and take that in, like whoa. Right? It's really high.
It seems high
recently,
but it's average
with the recency bias, as you mentioned. But there's no reason to assume, or accept that they're just going to go higher going forward. The Fed has committed to stamping out inflation. And they do that by increasing short-term interest rates. So the effect has been the kind of one of the side effects has been to increase longer term interest rates as well. So for example, the yield rate that's looked at most frequently in the housing market is the 10-year treasury rate. And that has gone from at the beginning of the year from 1.5% to now it's 3.2%. Might be a little bit lower today. So that's an increase of about 1.7% this year. But wait, 30-year mortgages have gone from 3% to 6.7%. So that's a 3.7% increase. What gives? That's a conspiracy.
Watch out.
Those guys are trying to make money, right? Like the oil companies.
I mean, yeah, if you didn't know, you would totally think that they're just jacking up the rates on us. Okay, so what's the reality?
Well, the reality is they are jacking up the rates because what happens is if you're a mortgage lender, you lock in your mortgage 30, 60 days ahead of time, right? And so you can't close the deal for another 30 days, 60 days. And you don't know what the rates are going to be then. And so you might end up holding the bag because the way things are changing so frequently, they're hedging their bets basically and saying, well, we don't know how much higher they're going to be. So we're going to charge a higher rate so we can off this loan to our third-party buyers, the investors that buy these things for sure. And, but so once, anyway, so if the market was calm and flat, more than likely the interest rate on the 30-year bond mortgage rate would be closer to 4.7 instead of 6.7.
Yeah. So just kind of waiting to see what the Fed does in the next couple of months and making sure that they're covered.
Things just have to calm down.
Yeah.
Right.
And so, by logic, if you are out there as a buyer looking to get a mortgage today, never to fear. It's not an endless upward cycle here. And in fact, over the next couple of months, you'll probably see these things, either equalize or even come down a little bit once we get a good handle on what the Fed is doing. And remember, the Fed is just trying to get inflation back to stable, which is 2%. And once they achieve that, they'll stop raising interest rates. Mortgage rates will then calm down and stay a little bit more fixed until the next thing happens.
And they might even start coming down.
Potentially.
Right?
Yeah.
For sure.
So, consider this. A lot of people who are in that buying frenzy right now, like, I want a mortgage rate at 6.7, not 8%. Oh my gosh. And so they're going out and they're buying a home at a really high price because prices are still pretty up there. And they're trying to get the mortgage at 6.7%. But remember, over the life of a 30-year mortgage, interest rates will change a lot. Just look at the last 30 years. You will have opportunities to refinance your mortgage. And so and you could look at the math on this. In most cases, it works out to where you're better off paying a higher interest rate to start and getting a lower price on your home than getting a lower price on the home and paying a higher interest rate, because you can refinance that mortgage in 5, 10, 15 years where you can never go back and lower the purchase price of your home.
Wouldn't that be great if you could?
Yeah. So I guess the message to people is you don't necessarily have to scramble out and, try to lock in an interest rate today at potentially 0.5% lower than it's going to be in maybe a month or two, right? I mean, it's not a big scramble. And just know for everybody over a 30-year time span, there'll be lots of opportunities to make changes to your mortgage. It's not a forever thing as you might think.
Yeah. We could still be seeing 3% mortgages in a few years.
Sure. Why not?
There's no reason we don't have to, if we get back to price stability.
Yeah.
So this is a good time to talk about ARMs, not these things, but adjustable rate mortgages. And for years now, people have not wanted to even think about those because fixed rate 30 years, 3%. I mean, come on.
Yeah. And they're kind of a bad word from 2008. Still,
people have been sort of trained to think ARMs are bad, but they're not bad. They're actually really good tools for the right situation. So for example, we said the 30-year fixed rate is 6.7%, while the 15-year fixed rate is closer to like 5.4%. So there's also adjustable rate mortgages that are even cheaper still. So for example, the 7-year ARM, where you basically have your the rate locked in for the first 7 years and then it goes adjustable, is currently 5.16%. So that gets you, 6.7 to 5.16. That's about a 1.6% reduction in rate, which would be a lot of money over on $1 million mortgage, it's $16,000 a year of interest savings.
Mm-hmm.
Now, so this would be a good idea if you think you're only going to live in the house for 7 more years or less, right? Because then there's no chance you're going to end up going above the 5.16. Or it could be an option if you think, like we do, that rates could end up going lower. Why lock in 6.7 if you could lock lower?
Yeah,
right.
Exactly.
Or you can get a lower rate down the road.
Mm-hmm.
So if you believe that, then it could make sense to go with you got 7 years to let that play out.
Yep.
A lower rate for sure. So these are not inherently risky propositions, these ARMs. They are actually really good. I want you to keep them on your radar for the right situation. They also often have lower fees than the 30-year fixed mortgages, but not always. So for example, there's a 5-year ARM that I saw today that had a rate. The rack rate looked like it said it was 4.18, which is like, whoa, that's really good.
Screaming deal.
But if you look at the APR, which means the annual percentage rate, which incorporates all the upfront fees that they have, it was 5.72. So, woof is right. So you have to be really careful. You have to look at the APR on these things and not just the rack rate that they advertise, because they could be much, much, much higher. And that, well, go ahead.
Well, I was just going to say that, for the last couple of years, you really haven't had to shop your mortgage that much. Everybody had the same low rate and the same closing costs. And now it sort of pays to shop your mortgage a little bit more and to understand what these different things mean when you're looking at it. And so maybe get a couple of quotes from a couple of different brokers, because you never know what you might find buried in that fine print. We're back to the days of more complicated mortgages.
Yep, for sure. So, let's see. Did you go?
Let's say, well, yeah. So, okay, we've talked about buying and selling, and the frenzy is sort of dying down. Adjustable rate mortgages. Now let's talk about if you need cash, because that's not. Buyers and sellers aren't the only people looking for mortgages. A big portion are people who, like me, had a pipe burst in their kitchen and suddenly need to remodel their home.
Life goes on.
Well, the insurance isn't paying for everything. Surprise.
Yep.
Or, your kid is starting college this year and your portfolio's down. All sorts of reasons why you might want to take money from your home. So let's say you have a 2.75 or 3% fixed rate mortgage, and now you want to tap into that equity. Should you refinance your entire mortgage now at 6.7% in order to get that cash? What do you think, Rich?
I say absolutely not. I think no.
No, absolutely not. That's ridiculous. And if you have a mortgage lender telling you to do that, cash out, refi the whole thing, you should say something like, you're going to have to pry that 3% mortgage out of my cold, dead hands. That thing is gold. Do not touch it.
Oh, absolutely.
Yeah. And so, in fact, if you get a recommendation like that, my advice to you is to say next, because that person is not, they're taking you for a ride.
Right. Absolutely.
And it makes sense, right? They want to loan you money at 6% instead of 3%. And hello, the commission's higher. So,
and the lender wants you out of that mortgage at 3% because they can make more.
Yeah, absolutely. Yeah. So, and here's another thing to consider. If you're borrowing at 3% and inflation is 8+%, the actual cost of borrowing that money is -5%.
They're paying you to borrow money.
Basically, yeah. And so the lender does not want this. They want you out. Don't let them. Hang on to those.
Right.
So if you need to tap equity in your home, the ideal thing to do right now today is get a HELOC. That's a home equity line of credit. And you might be like, oh no, but those rates are variable. And they're higher.
Red alert. Yeah.
So what do you have to say to that?
All right. So I want you to think, logically about this. Let's just say you have a $700,000 mortgage that is at 3%. I know a lot of you have mortgages that are like 2.75 or even lower. But let's just say it's 3. So the interest that you're paying in a year on that at 3% is $21,000. Okay. So now let's assume you need $200,000 to remodel your kitchen or whatever you're going to do. Put a kid through school or something. Dumbo Lending convinces you to refinance that mortgage into a brand new $900,000 mortgage at 6.7%. So guess what your annual interest payment is going to be now? More than $60,000. So you're gonna jack up your interest by $39,000 from $21,000 originally to more than $60,000 now to borrow an extra $200,000. That means you're paying $39,000 to borrow $200,000. That's about 20% interest. You're better off borrowing money from the mafia if you need it rather than doing that. That is insane. Do not do that. That's why we say Cold dead hands, no.
Yeah.
Yep.
Okay, so give them the numerical example. If this person did a HELOC instead, what sort of extra interest would they end up paying at the higher interest rate? How does that math
Okay, so a HELOC, the lowest HELOC I could find right now on the internet was costing 4.27%. So you would keep your first mortgage at $700, you get a $200,000 HELOC at 4.27%, variable. I know it's variable, but the interest would be about $8,500 per year initially. So now when you add that 21,000 first mortgage interest and the second, you're under $30,000 interest instead of paying 60 to refinance the whole thing. So that's much better. And even if the HELOC rate does go up in the future, it's not going to go to 20%.
Yeah.
Most of those are contractually guaranteed to maybe go double or something. They can go to 10, whatever. So the limits are just not that high.
Yeah.
So
you're
we're just
never going to end up paying the amount of interest that you would if you had done the cash.
Absolutely
out.
not. Yeah. So HELOCs are the way to go right now. You're going to see more and more banks doing those because they know you're not. It's the cold dead hands thing. They know you're not going to let that go.
Yeah.
So we're in a different environment than we were. It's more unforgiving. And so you have to be much more savvy as a borrower and a homeowner than you had to be before, where you could just, refinance it, get a new car, get a new first.
Yeah.
It was easier.
Yeah.
Now, not the same.
Forget it. Yeah. And I think another thing that I want to caution people is it's not just about your payment. And so a lot of lenders will give this to you in terms of, well, your old payment was $2,100 and your new payment is $2,000.
Oh, yeah.
You're saving $1,000 a month at this new 7% interest rate. What they're doing is they're tacking on additional years on your mortgage. So you're like, maybe you were 10 years into your mortgage and now you're getting a new 30-year fix. You're adding 10 years. So you're adding that on the back end and you're actually paying a lot more over the life of the loan. And this is sort of a common thing, like your payment. So just please watch out for that and take a look at the interest that you're paying over the life of the loan and make sure that you're also including any closing costs or points that you're paying in the break even on this calculation.
Yeah. The payment is the dopey way to think about it. The interest that you're paying is the smart way to do it.
You just have to be a little more savvy.
And I do want to cover one thing. I keep getting asked about paying points on mortgages, and especially now when things are in flux, there's a lot more opportunities to pay points and buy down the rate that you're paying. So here's the rule of thumb. You have to look at how many years, if I pay a point, how much is that going to reduce my interest rate on the mortgage? So if they say pay a point, which is 1% upfront, a fee, and if they're going to save you like an eighth of a percent, it's going to take you 8 years before you break even on that point you paid, right? But if you pay a point and you're going to get 1/4% decrease in the rate, now it's only a 4-year break even. So those are always moving around. So you have to look at that and decide, is it worth it for me? Because if it's going to take you 8 years to break even, more than likely you're going to refi way before that. So you're never going to break even by paying that 1%. So don't do it. You have to, again, got to be savvy.
Yeah. And a little bit of long-term thinking.
Yep.
Okay, so buyers, sellers, mortgages. Now we have a special surprise for everybody today.
Yeah,
so
this is great.
So we're going to start talking to some first-time home buyers here who might need a little bit of assistance with their down payment. Super common question among younger people today. The millennials joke about, if I had one less avocado toast, I'd be able to buy a house. They
Lattes,
just are priced out of the market, and this happens to a lot of the children of our clients. So there are ways that you can reduce your down payment and closing costs. There's some special programs out there right now, and they're legit. Not joking. You can actually do this.
Legit.
So I want to introduce our colleague. He's our new support advisor here at Monte Group. His name is Leo Bojorquez. And a few weeks ago, we were discussing a new program for first-time home buyers where those with moderate incomes can get loans for the down payment, and the loans are forgivable. Forgivable. Yes. So Leo is what you would call a Colby quick start, if you know what that is. He's a mover and a shaker, and he got right on this. By the day's end, he had all the info on this program. He had found, in fact, another program to help with closing costs. And today, a few weeks later, he's closing on his first home with no out-of-pocket costs. So Leo, welcome to A Place of Possibility. Tell us about this down payment program that you tapped into.
Thank you. Thanks for having me, and happy anniversary. I'm definitely a mover and a shaker. As soon as I heard about this program, actually from Richard, he sent me over an article, and I did some quick research and started reaching out to lenders and agents, and some of them weren't aware and some of them were. But fingers crossed, I may be able to close on my house tomorrow using 2 different programs, one for down payment and one for my closing costs.
Oh my gosh. Okay, so let's talk about the down payment program first. So what are the income limits to qualify? Because it says, I don't want anyone thinking it's like we're paying our people moderate salaries over here. So like, what is the limit?
No, DMG's been very fair to me. The first program is called the Equity Builder Forgiveness Loan. So within the name, every word has a purpose within it. But the income limits are per county. So each county has its own income limit, and it goes from the average median income. So for instance, in Santa Clara, the income limit there would be $120,000 per household.
Per household. Okay.
So if you're a single buyer, it's $120,000.
Wow.
So
it's very reasonable on some Bay Area salaries.
Yeah.
Yeah.
Great.
Okay.
So how much are we talking about in terms of house value that you can buy with these benefits?
Yeah, I checked HUD today, and for like the San Francisco and Oakland, Berkeley area for a FHA loan, there's a ceiling of $970,000 purchase price. So if you combine that with the Equity Builder Forgiveness Loan, then you can get up to $97,000 loan, which is a loan with 0%.
Oh my gosh.
0%.
Oh my gosh. And so go ahead.
No, so they give you 10% maximum, right?
Yeah, so it's 10% maximum off the purchase price. If we're going from $970,000, that's $97,000.
How does this become forgivable?
So it's prorated. It's 20% every single year. So if we were going to use an easier example of $1 million, that would be $100,000 down payment, and then 20% of $100,000 is going to be $20,000 every year gets forgiven, and in 5 years the entire loan would be forgiven.
They're just writing it off.
So you're basically getting that money free, tax-free from the government, $100,000.
Correct. And one thing I should mention is that I did ask one of the programs if the interest rate environment changed and interest rates dropped, if I could refinance. And they said at that point we would have a conversation. If it's beneficial to you, we may be able to refinance it. So, you're locked in for 5 years, but they're working with people to help them build equity in their homes.
Yeah.
Wow.
And it would have to be a huge drop in interest rates to justify a refinance if you had to pay. I mean, it just makes so much sense to stick with a slightly higher mortgage rate for a couple of years.
Man.
Wow.
Man. That's crazy.
That's awesome.
That's wonderful.
Are there still funds remaining in the program? Because like sometimes people will Google this and then it'll be like, I'm running out of money. How was that for you?
Yeah, so there's 2 programs, the Equity Builder Forgiveness Loan. That's the one with 10% for down payment. And that one, there's definitely enough funds in it. I spoke to my agent as well as multiple lenders now, and they're implementing that into their strategy to get first-time home buyers qualified for homes they previously couldn't qualify before. So there's definitely enough funds in that one. There's another program called LIFT, which helps you out with your closing costs. And that one is a little bit more scarce, so to speak.
Okay.
So on that program, they will run out of funds, but you have to just continuously reapply. I think it's like every Thursday, like 9 a.m. I was next to my computer hitting that submit button, making sure I was the first one in line. But that one's a little bit more scarce than the others.
Yeah.
How does that one work?
So it has the same requirements for like income limits, 120,000 for Santa Clara, San Benito, I believe. Mm-hmm. So there's actually a few more requirements, but one of the requirements is that you take this home buyer's education course online, which is like $99. It's at your own pace, and it teaches you about like homeowners insurance and property tax, and it just educates the person borrowing the funds to purchase your home. So that one works exactly like the Equity Builder Forgiveness Loan. It gets forgiven in 5 years, and it's prorated for 5 years. And then that one you can apply towards your closing costs up to $25,000. So if your closing cost is less than $25,000, you take that remaining and you put it towards your down payment.
That's awesome.
So a person could theoretically buy a house for almost nothing down. Oh.
Right. So if you you can use the Equity Builder with the LIFT program to cover your down payment and your closing costs, and you can walk into a house with 0 down. And
That's so awesome.
In the San Francisco Bay Area.
Yeah, these programs work with HFA, conventional, VA. They'll all have slightly different like credit score requirements, but that would be something that you work out with like your lender and things of that sort. So I know that's like an important question for some borrowers out there.
Mm-hmm. Were there any other hoops that you had to jump through to make this happen?
I was very persistent on the lenders and the LIFT program and CHDC when I uploaded my documents. Have you looked at my documents and are you reviewing? Where are we with this? So they have to review your budget, and you have to have this counseling meeting as well that it gets you prepared. And they set out a budget for you. You work with them to set out a budget just to make sure that you're able to make these payments in the future. So we don't come across that same problem that we had in 2008. The borrowers can actually meet their requirements.
So awesome. You're walking in, you're going to basically get a house. They're going to give you the keys to a house, and all you've given them is a signature that you're going to pay them back.
I smiled once or twice.
It's amazing. Yeah. No cash out of pocket.
That's right. No cash out of pocket. Down payment. And so I have instant equity in my house.
Oh, that's a good point. You've got 10% equity, right?
That's why. That's why I said in the beginning that it's an equity builder, and that's what it does. It gives you instant equity into that home.
That's amazing.
So this is for first-time home buyers, right? What's the criteria for that?
Yeah, there's a caveat to that. Even if you're not a first-time home buyer, you could still qualify as long as you haven't owned a home within the last 3 years. So if 4 years ago you bought and sold a home and you haven't owned one since, you can still qualify for this.
That's awesome.
You can be first time again.
Yeah.
All over again.
Yeah.
Can't do that on many different areas of life. No repeats. So what advice do you have for other people in your shoes, Leo, that are just like sitting back, not sitting back. They're feeling kind of desperate, right? And like, there's no option for me. Yeah. I'm out of the loop here.
It can be very discouraging going out there and getting overbid by 200,000. You feel like you have no chance. But you just want to put yourself in the right position. And by doing that, you just want to have all the documents you're going to need for a loan or one of these programs, which is going to be like your bank statements, your pay stubs, your tax documents for 2 years. So any statement that you would use for, applying for a loan, you would use for these programs. So you just want to make sure that they're all put together in either a file cabinet or on your desktop somewhere secure, where you can instantly upload those to online and then start that process. Because the last thing you want to do is miss out on $50,000 or $100,000 because you didn't have your bank statements ready and somebody else got priority over that loan that you could have had.
Right.
Huh. Wow. Great
Very
advice.
Cool. Yeah.
Great advice.
Thank you. Thank you so much for coming on and talking about this program with us. And congratulations. It's so exciting.
Congrats. Homeowner.
Woo-hoo.
I appreciate it. Thank you, guys.
Yeah.
That'll be awesome.
So I think we might have some questions coming in from Facebook here. Minimum requirements for credit scores.
For a house?
I'm going to guess that's for a home purchase.
I don't know what Fannie and Freddie are. I want to say they're like 690 or something, or 640.
I've seen as low as like 650 in Fannie and Freddie, but generally, to get a really favorable interest rate, you're looking at over 700, 750.
Yeah.
I don't know. I think you probably wouldn't qualify for the program. Leo was just talking about if you're below 650. So that's kind of like the number you're aspiring to or higher if you're buying a home. And then if you're buying with a spouse or a partner, they generally take the lower credit score.
Right.
Yeah. So they'll look at all three of the bureaus for each of you, and then they'll take the lowest, and that's the score you get to use.
Yeah.
So
yay. Mr. Producer, do you have a different answer? Because it sounded like you had the answer in your hands there.
So it does. It actually does look like I have that for an FHA or a VA loan. That would be 640 is the
640 for FHA, VA.
A conventional, generally around 680.
Conventional 680. Okay.
Yeah, not as high as we thought.
That's good.
You're
That's
in
good.
it. Okay, cool.
Awesome.
Are there any other questions that came through? We have a producer sitting here. Everyone, it's like we're talking to the wall.
We're going to have to get you your own mic.
No other questions.
Okay. Well, so the key takeaways today that we hope you'll walk away with are that it's the seller's market is cooling down. It's not vaporizing and it's not collapsing, but prices are going to start trending down and cooling off a little bit, most likely. Rates have been going up a lot, but they will probably stabilize at some point. They're still historically pretty average. And do not, if you need money, a cash out, do not refinance your entire mortgage. Use a HELOC, and if you're a first-time home buyer, take advantage of these programs. They are legit, right?
Yeah,
they are
yeah.
amazing.
Kids
Free money from the government.
Yeah.
That's great.
Oh gosh. Well, thanks everybody for joining us. We'll have show notes listing some of the numbers that we went over today, as well as the details about the program that Leo talked to you about. So you can grab those and make some choices for yourself. Please write to us or call if you have any questions about this or any other financial topic. If you would like a copy of Endless Inheritance by Richard Del Monte, please click on the link to order that. We'll send you a copy. And then, as always, we offer a consultation if you have any questions about your finances or your investment management. Free, baby. Yeah. So we encourage you to schedule one of those. If you're interested, happy official summer, everyone. We'll see you in 2 weeks.
Thank you again for being with us. And remember, you're invested and so are we.